What if I told you that the greatest economic catastrophe in human history was not caused by a natural disaster or a sovereign military conflict, but by a calculated and entirely legal mathematical scheme designed by Wall Street bankers to extract wealth through unregulated leverage? Welcome to Money's Hidden Past. Rich people lied. We fact-checked. Today we are stripping down the financial crash of 1929 and exposing exactly how a stock market bubble destroyed the global economy. The history books describe the Roaring Twenties as an era of cultural prosperity, a golden decade where technological innovation transformed daily civilian life. But beneath the jazz music and the mass production of the automobile, the financial elite were constructing a massive debt-fueled house of cards. Following the conclusion of the First World War, the United States emerged as the undisputed global creditor manufacturing infrastructure and exporting products to a devastated European continent and flooding the domestic economy with an unprecedented supply of liquid capital. For the very first time in modern economic history, the ordinary working-class citizen gained access to the stock exchange, transforming a highly exclusive club for elite industrial magnates into an unregulated public casino open to the retail consumer. Wall Street brokers introduced a destructive financial mechanism known across the industry as buying on margin, allowing a retail investor to purchase corporate equity for a fraction of the price and borrow the remaining 90% directly from the brokerage firm. This mathematical leverage created an illusion of permanent exponential growth because buyers possessed 10 times their actual purchasing power, flooding the equity markets with completely artificial phantom capital and driving the valuation of corporate stock into the absolute stratosphere. When a shoeshine boy can borrow capital to speculate on railroad equity, the market ceases to function as a mechanism for pricing physical value. It becomes an engine of pure psychological mania, driven entirely by the biological human desire for unearned wealth. The corporate executives and the banking elite watched this mania unfold, and instead of protecting the integrity of the financial system, they poured gasoline on the speculative fire. Because they extracted commission fees on every single trade, financial syndicates and wealthy pool operators manipulated the prices. They bought massive blocks of obscure corporate stock to generate artificial volume, paying media columnists to print fraudulent positive news stories, and dumping their equity onto the retail public at the absolute peak. The mathematics of leverage operate as a ruthless double-edged sword. When you borrow money to amplify your financial gains, you simultaneously guarantee the destruction of your baseline capital if the underlying asset drops by a mere 10%. In the autumn of 1929, the fundamental reality finally arrived. The Federal Reserve raised interest rates to slow the runaway speculation, and the elite insiders quietly began selling their massive stock positions, triggering a slight downward trajectory in the highly inflated market prices. This minor market correction initiated a mechanical chain reaction, forcing the nervous brokers to issue mandatory margin calls demanding that retail investors immediately deposit physical cash to cover the loans they used to buy the depreciating stock. The working class investors did not possess the physical cash, forcing the brokers to aggressively liquidate their stock portfolios, dumping millions of shares onto the open market simultaneously and triggering a catastrophic mechanical death spiral. On October 24th, historically known as Black Thursday, the panic breached the walls of the New York Stock Exchange. The ticker tape machines fell hours behind the actual trading volume as desperate investors frantically attempted to exit the collapsing market. A consortium of powerful Wall Street bankers attempted to halt the slide, pooling their private capital to purchase blue-chip stocks above market value, projecting an illusion of institutional confidence to calm the retail herd and successfully pausing the panic for exactly one weekend. But the mathematical reality of the margin debt could not be suppressed. When the market opened the following Monday, the selling pressure resumed and the institutional bankers abandoned their stabilization efforts, leaving the retail investors completely exposed to the algorithmic slaughter. 5 days later, on the infamous Black Tuesday, the market entirely broke 16 million shares, changed hands in a single session of pure terror, vaporizing billions of dollars of theoretical wealth in a matter of hours and erasing the financial gains of the entire previous decade. If the destruction remained isolated to the stock exchange, the working-class citizens who avoided the casino would have survived. But the architecture of the 1920s banking system was entirely fused to the speculative mania of Wall Street. The local commercial banks across the nation committed a fatal sin. They took the safe physical deposits of the ordinary working class and blindly gambled that generational wealth in the stock market, chasing the exact same speculative returns as the retail gamblers. The banks operated on a fractional reserve system, meaning they only kept a tiny percentage of actual cash in the vault, loaning the rest of the capital to speculators and brokerage firms, completely tying the survival of the bank to the price of corporate equity when the stock market violently collapsed and the equity vanished. The physical cash inside the bank vaults completely evaporated, meaning the money you deposited into your local savings account simply did not mathematically exist anymore. When the panicked public realized the banking system was hollow, they rushed to the physical branches to withdraw their paper currency, creating a psychological phenomenon known as a bank run, where the first person in line survives and everyone else goes bankrupt. Thousands of local community banks failed and permanently closed, vaporizing the life savings of millions of families overnight and instantly triggering a massive contraction in the physical money supply, which froze the gears of the entire domestic industrial economy. Factories completely stopped manufacturing physical products. Corporations fired millions of workers to protect their remaining capital, and the unemployment rate skyrocketed to 25%, plunging the nation into the deepest economic depression in human history. The Federal Reserve possessed the theoretical power to stop the banking collapse. They could have acted as the lender of last resort and injected liquidity, but they were mathematically constrained by the rigid rules of the gold standard, which tie the issuance of paper currency directly to physical gold reserves. Printing money to rescue the failing commercial banks would have forced the government to abandon the gold peg, a radical economic move that the conservative central bankers refused to execute, choosing instead to let the banking system completely burn to the ground. This catastrophic financial collapse refused to remain contained within borders because the global economy was heavily reliant on a massive network of international debt established during the reconstruction of the First World War and tethered together by the inflexible architecture of the gold standard. As the domestic banking system failed, the American financial institutions desperately recalled the massive loans they issued to European nations, stripping the physical capital out of the vulnerable foreign economies and exporting the financial contagion directly across the Atlantic Ocean. The withdrawal of American credit shattered the German economy, destroyed the industrial output of the British Empire, and collapsed the sovereign banking systems across the European continent, creating a decade of severe global economic despair. This massive structural failure of the free market capitalist system created a highly volatile political vacuum across the globe, allowing totalitarian regimes to seize sovereign control, promising economic salvation to a starving and desperate working class. The global devastation forced the federal government to finally recognize that an entirely unregulated financial market is a weapon of mass destruction, requiring an unprecedented intervention to rebuild public trust and completely rewrite the rules of modern economic engagement. Before the crash, the government operated as a passive observer, believing that financial markets possessed a natural self-correcting mechanism and that federal intervention would disrupt the efficiency of capital. But the Depression proved that unregulated markets inherently self-destruct. The political administration executed a massive legislative overhaul, fundamentally altering the relationship between the state and the market, and proving that the corporate banking elite cannot police themselves because greed mathematically always overpowers corporate responsibility. The government launched a massive congressional investigation, officially known as the Pecora Commission, subpoenaing the most powerful Wall Street bankers and forcing them to testify, exposing the insider trading and the tax evasion to the furious public. This public exposure provided the political capital required to pass sweeping reform, resulting in the creation of the Securities and Exchange Commission, establishing a permanent federal authority to police Wall Street, and making it a federal crime to lie to the retail investor. Before the creation of this regulatory commission, corporate insiders operated entirely in the dark, manufacturing fake revenue reports to manipulate their stock price and selling their shares. Before the public discovered the fraud, the commission mandated absolute transparency and standardized accounting, requiring an independent audit of every single public balance sheet and threatening corporate executives with severe federal prison sentences if they attempted to deceive the retail market. They outlawed the manipulative syndicate pools. They strictly regulated the exact amount of margin debt a broker could issue, and they forced every publicly traded corporation to register their securities, creating the foundation of modern financial compliance. But the absolute most critical piece of financial architecture was the historic passage of the Glass-Steagall Act, a piece of legislation designed to build an impenetrable structural firewall directly through the center of the American banking system. The law legally separated boring commercial community banking from the high-risk casino of Wall Street investment banking, making it completely illegal for a bank to take your checking deposit and gamble that specific currency on the stock exchange. If a corporate executive wanted to speculate on equity derivatives, they were forced to use their own private investment capital. They could no longer use the working class savings accounts as a massive slush fund protecting the basic civilian economy from Wall Street gambling. The government simultaneously established federal deposit insurance, guaranteeing that if a local commercial bank collapsed, the sovereign treasury would entirely reimburse the retail depositor, permanently eliminating the psychological terror of the bank run by ensuring the deposits. The government restored faith in the banking system, convincing the traumatized public to pull their cash out from under their mattresses and redeposit it into the commercial banks restarting the flow of credit and resurrecting the domestic economy. These strict financial regulations operated flawlessly for over 60 years, providing a stable foundation for the greatest period of economic expansion and preventing a major banking crisis for multiple generations, proving that structural guardrails actually protect the free market. But the financial elite will always attempt to dismantle the guardrails. They spent decades lobbying Congress to remove the restrictions, constantly arguing that regulation stifles corporate innovation and prevents American banks from competing on the global stage. Their definition of innovation is simply discovering new methods to leverage the working class. And in the late 1990s, the banking lobbyists succeeded, convincing the government to completely repeal the Glass-Steagall firewall, allowing the commercial banks to merge back with the Wall Street casinos. This repeal set the mathematical stage for the exact same collapse, allowing the banks to gamble working-class deposits on toxic mortgage derivatives, and leading directly to the massive financial crisis of 2008, proving that financial history operates in a permanent, unyielding loop. If this breakdown of the 1929 crash and the mechanics of global financial regulation fired you up about taking total control of your permanent financial architecture, then do me a favor right now. Smash that like button to let the algorithm know this factual historical conversation matters. Share this video with every friend and family member who needs to understand how the real financial world operates. Let us keep exposing the true mechanics of wealth and power. I will catch you in the next one, where we break down the next hidden chapter in the long history of money and corporate authority. Until then, stay informed, stay skeptical, and remember that an unregulated financial market always destroys itself, and the working class always receives the bill for the cleanup.